Hi everyone, let's continue our series on gathering the input data you need to evaluate the financial viability of your business idea. In our previous videos, we discussed pricing strategy, sales planning, and the information required to build an investment plan. You'll find links to those videos in the description below. Today, we'll focus on collecting the input data needed to model your fixed operating costs. If you have additional ideas or insights based on your own experience, be sure to share them in the comments. Our goal is to turn this video series into an open encyclopedia for aspiring entrepreneurs, people who have a business idea but don't yet know how to evaluate its financial performance. So, subscribe to the channel. There's a lot of valuable content ahead, all designed to help new entrepreneurs make better business decisions. In the coming videos, we'll cover how to collect input data for variable costs, payroll, production planning, sources of financing. We have been developing business plans and financial models for over 20 years, and we're excited to share our experience with you. So, let's get started. Let's start with a definition. Fixed costs are expenses that remain relatively stable over time. They do not increase when your revenue grows, and they do not decrease when your revenue falls. In other words, there is no direct relationship between fixed costs and revenue. Next, never make the mistake of simply copying fixed operating expenses across the timeline of your financial model. Despite their name, fixed costs can fluctuate over time, and today we'll discuss these fluctuations in detail. This category of expenses can be particularly deceptive. If you fail to account for these variations, there's a high probability that your business will experience a cash flow gap, and you'll likely underestimate the amount of financing your project actually requires. The first thing you should do is take a sheet of paper and create a comprehensive list of every operating expense your business is likely to incur. Next, evaluate each expense and determine whether it increases as your revenue grows and decreases as your revenue falls. If it does, classify it as a variable cost. We'll cover variable cost in detail in one of our upcoming videos. If an expense remains relatively stable and has no direct correlation with revenue, classify it as a fixed cost. That's exactly the type of expense we'll be focusing on today. Now that we have a list of fixed operating expenses, it's time to start analyzing it. The first question to ask is this: over the course of a typical year, does any fixed expense fluctuate with the seasons? In other words, does the amount of any expense change during spring, summer, autumn, or winter? If the answer is yes, those seasonal fluctuations should be identified and documented in detail. They need to be reflected accurately in your financial model, rather than assuming the expense remains constant throughout the year. Next, consider whether your fixed expenses fluctuate over the course of a typical week. For example, some expenses may be higher on weekends and lower from Monday through Friday. In other businesses, the opposite may be true. Think carefully about every fixed expense and document any weekly patterns or fluctuations you identify. These variations should also be incorporated into your financial model to improve its accuracy. Different fixed expenses can have different payment frequencies. Some expenses occur once per month, others once per quarter, some twice a year, and some only once per year, or even at irregular intervals. Your task is to carefully recall and document all of these patterns in detail. Fixed costs may also follow a specific annual payment schedule. For example, certain expenses might consistently occur in specific months such as March, September, October, and December. Ask yourself, does your business have any expenses that follow this kind of structured or irregular timing pattern? If yes, they must be explicitly recorded in your financial model. Fixed costs can also depend on the stage of your business development. They may increase in a step-like, non-linear way when you reach certain thresholds, such as a specific number of customers, a defined level of revenue, or a certain number of employees. In other words, fixed costs do not always grow smoothly. Instead, they often rise in steps once your business reaches a new operational level. This is another important factor that must be carefully considered in your financial model. Different fixed expense items may also start at different points in time. Some expenses begin from the moment revenue generation starts, while others may start after a certain number of months from the beginning of operations. There are many possible timing rules and logic patterns. Your task is to carefully recall and define all of them in detail, because each of these rules must be reflected correctly in your financial model. And of course, if none of the scenarios described above apply to your fixed costs, you can simply carry them across the entire planning horizon of your business model. So we have now reviewed what types of input data you need to collect in order to properly define the fixed costs of your business idea. We started with the definition. Then we noted that all project expenses should be gathered into a single list and divided into two groups, fixed costs and variable costs. After that, we looked at seasonal patterns of fixed costs within a typical year. Then we considered that fixed costs may also fluctuate within a typical week. Next, we discussed that fixed costs can follow different payment frequencies and timing rules. We also identified that they may have specific and sometimes complex annual schedules. In addition, we highlighted that fixed costs can depend on the current stage of your business and may increase in a step-like manner as your project grows. We also noted that some costs may start at the very beginning of revenue generation, while others may start at a specific future point in time, defined by you as a project parameter. And finally, in some cases, these costs may truly remain stable month after month if none of the previously described factors apply. So now you can clearly see that fixed costs are not always fixed. This category of expenses can be quite tricky and often confuses beginner entrepreneurs because of its name. If you have anything to add, feel free to write it in the comments. Our goal is to turn this video series into an open encyclopedia for aspiring entrepreneurs who have a business idea but don't yet know how to approach it or where to start. In upcoming videos, we will cover how to collect input data for payroll, direct costs, production planning, project financing, and much more. So subscribe, there's a lot coming. We have been developing business plans and financial models for 20 years. All links are in the description. See you in the next episode.